Hello, 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 and welcome, welcome, welcome. It is time for day 2. Now, just type in the chat box, how you feeling? How's everyone been? Lots of information yesterday. Are you ready to rock and roll and get into it? I just want to make sure that you can all hear and see me clearly. Yep. Okay, excellent. Kerry, well done to you. Jane, well done to you. Excellent, excellent, excellent. Okay, so we've got an exciting day ahead of us today. And let me get up and share my screen here. I want to start with a video. So this is a little video that we made a while ago. Actually, let me make sure that I'm sharing audio here when I share this. And what I basically want to do is I want to share this little video because this is going to explain to you. Today, we're going to talk about what countries to invest in, what currencies to invest in, and also what are the top 15 assets. But what I want to give you is a bit of peace of mind. I want to start with a video that's literally going to show you how you can do this and how you can access it. So let's start with this little video quickly. I'm going to get the video up for you. And where's my video gone? Okay, let's rock and roll. Enjoy this video.
Real estate. It's one of the most reliable and profitable investments in the world. 49% of the world's wealth is held in real estate. It's what built the wealth of kings and aristocrats. But investing in real estate, for the average person, is simply out of reach. It's a playground normally reserved for millionaires or billionaires. Only the top 0.1% of people own and invest in commercial real estate. There's a wealth gap across the globe that's pricing out the middle class from investing in one of the best ways to build and preserve wealth, which will enable them to give their children a better future. Studies prove that children who grow up in households who have stable financial futures do better in life. That's a fact. But too many people don't have access to it. We want to change that. Let's open up the opportunity to people who work hard, manage their finances wisely, and need a place to invest for their family's future. What we're doing at Wealth Migrate is exactly that. It's simple, but incredibly powerful. We're eliminating the typical barriers to entry when investing in real estate, whether that's knowledge, money, experience, or access. Access to what the top investors know and are able to invest in, but that you can't. We're giving people the opportunity to invest globally in commercial real estate through the internet, right alongside high-profile investors, and earn the same returns and monthly dividends. We're using the internet and our technology to give everyone access to real estate investment opportunities you've never had access to before. By giving you access to global real estate investing, our goal is to empower 1 billion people and close the wealth gap that currently exists. You don't need to invest huge amounts of money to become a part owner of a project. It levels the playing field and helps developers start new projects. It's a win-win for everyone. And then there's our technology, our secret sauce that helps you make smart investments. Now it's your time to grab this opportunity. Do it now with our trusted, secure real estate investment platform. Visit www.wealthmigrate.com to see what amazing opportunities are available right now.
That gives you a little window into what we've been building for the last decade. And it's going to kind of give you a bit of an essence of what we are about to embark on today, because you've heard me talking a lot about investing like the top 1%. And I showed you yesterday how you can use technology to invest like the top 1%. But now it's time to actually get into it. So day 2 is all about the types of investments, the asset classes, and the risk. And we basically got different types of investments, and we need to balance the risk and return goals, etc., in terms of what we're looking at. If I click through here, what we're basically going to be looking at is the different asset classes and risk. We're going to be understanding the relationship between risk and return in terms of the investments. We're going to be identifying your personal risk tolerance, and we're also going to understand how diversification can mitigate risk. So this is what we're going to be going on in terms of the whole journey, taking you through in terms of where we're at and how it's actually going to work. Right, a couple of guidelines. Now, I go through this every day just to remind you, but I do remind you, pay full attention. I know that someone actually said they're in hospital, so well done to to who said they were in hospital? Someone said they were in hospital. There we are, Justin. So anyway, well done to you. And the point being is that for me, it's about playing full on. Take notes, try and teach other people in the community, do the exercises, commit to action for 5 days, set yourself the goals, take action and have fun. You know, at the end of the day, we all know this, but children actually learn more than adults. And the reason being is that they have fun through the entire process. So these are just some guidelines. The other thing is that you've got the resources document. So you can go to the resources document at any time and you can literally get access to all the information. So if I click on it now and if you wouldn't mind just chucking the resources document there in the panelist link, I'd appreciate it, Shane. But if people just go to that resources document, then you'll basically be able to get access to everything. So if I click on it here, you can see it. It comes up with day 1. And there you got the recording. So people are always like, oh, where do I get the recording? How do I do this? Well, there's your recording. There are your action steps. I don't think Shane could make it any easier for you with literally links through. If you want to join the community, the WhatsApp group, take a discovery call, download the investor strategy sheet, join the VIP, or even share with a friend. You've literally got access to everything all in one place. And again, hopefully fairly logical, but today, once day 2 kind of opens up, here's day 2, and you can basically see day 2 is all here in terms of that process. Okay, so that's the first thing. You've got the group, so you can go and join the group. Again, if you didn't do this, I strongly recommend that you do. You can literally go here, you can go to the community, you can see what others are having to say, what their key takeaways were, which is fantastic in terms of the process. So well done to everyone that put their thing in. And what's nice, you can actually go down here to Diversification Challenge, and you can literally see all the people that have put stuff in with regards to the Diversification Challenge. So well done to all of these people, Jürgen, Simon, Kevin, myself, Kelly, Jacqueline, Jane, etc., etc. Okay. The WhatsApp group is there just to allow us to let you know what's going on. Now, I'm a big believer in simplicity as power. And so what's really, really important is that what we're looking for, our focus is globally diversified passive income and portfolio growth. Now, the formula on how to do it is we're going to diversify across countries, currencies, assets, partners, and time. And it's all about passive income. And what we do is we break it down into long-term planning, medium-term planning, and then daily activities and tasks. So this is what I do with my mastermind members. We get clear on their top 3 outcomes, their top 3 priorities, and their top 3 measures. We then have monthly check-ins, and then there's daily tasks and activities. This is the way to achieve any big goal in your life in terms of that process. Kevin, are there recordings of the VIP sessions? Yes, there are, if you're a VIP member. So if you're a VIP member, we actually put them in the WhatsApp group, and I personally posted it yesterday, so I know it's there in terms of, but you have to be a VIP member to get access to them. I do remind you that I'm going to bring this up every day so that if you feel overwhelmed, maybe take a picture of this, take a screenshot, do whatever you like, so that it just reminds you and says, oh, hang on, you know, like learning a bike. So you start off unconsciously incompetent, as in you don't know what you don't know. Then you go to consciously incompetent, where you now know what you don't know. Then you go to consciously competent, which is where you now know what you need to know and you're starting to do it, but it takes a lot of effort. And then finally you go to unconsciously competent, where you can kind of do it in terms of in your sleep, in terms of that process. Day one was all about understanding diversification. It was understanding the power of diversification and why it is so important, and why, as according to Ray Dalio, it's the single most important component to financial success. And what we also went through in day one is I showed you practically how you could do it, so that you don't just think that I'm sitting here hypothetically getting started. I then showed you using the hypothesis of how you basically do a dissertation or a master's on how you prove something. And we proved that diversification is the single most important component to financial success. I then went through the 5 myths that tend to hold people back. And I then gave you homework, and I said, you need to go and work out, what are you doing around diversification, et cetera, et cetera. And that's where we go to the homework. And I remind you that under the silver, it was to identify the risks associated with not diversifying. It was to write them down from what is stopping you from diversifying. It was fill in the globally diversified investor strategy sheet. So I hope all of you have printed your sheet and have your sheet. And if you have, then the very first block here is your 5 whys that you should have filled in. Then sign up for the investor roadmap. So again, this is free. So no one can come here and say that you haven't got access to the information, and you can even do it for free. So you can literally go to the investor roadmap, and there's 5 simple videos that will literally lesson 1, 2, 3, 4, and 5 that'll literally take you through how you can get started and invest. And then finally, share one key takeaway. And, you know, I see a couple of you did it, but my recommendation is that you all do it. Because if you're literally sitting there and you're figuring out what your key takeaways are, and you're sharing them with others, not only are you synthesizing the information for yourself, but you're adding value to others. And Zig Ziglar's principle is you can have anything you want in life if you help enough other people get what they want. So those were the action steps. Just my interest, type in the chat box. How many of you did your homework? Give us a yes. Give us a yes. Give us a no. Okay, so I can see a yes, yes, yes. Sorry, it's cold here, so I'm wearing a jersey, and apparently the mic's not coming through clearly. Is that a bit better? Is the mic coming through a bit better? Okay, cool. So, right, what was the goal? The goal is to create a list of assets or investments you currently hold, if any, and identify the concentration of risks. Now, I remind you, you don't need to do the goal today or even last night. You can basically wait until next week or the week after. But my strong recommendation is you try and make sure that you do all the silvers through the process. You've also got the book a discovery call. So if you want to sit down with one of our wealth coaches and understand kind of where you are and where you want to get to and help you create a plan for diversified passive income, then you can do that. You literally go to the link, diversificationchallenge.com/call. Okay. So today, I'm not going to be giving you any financial advice. I never do for the entire session, including the VIP session. But what I do is I share with you my lessons and what's worked and what hasn't worked, the mistakes I've made, so that you too can hopefully avoid them. If you want to upgrade to the VIP, you still can. You know, we constantly get amazing feedback from everyone. So it's always awesome. I don't know, for those of you in the VIP session, if you enjoyed it yesterday, I did give a sneak preview for something we're going to go through tomorrow, which is how do you build portfolios? How do you actually look at all of the different age groups? And based on the different age groups, what sort of asset classes should you be investing in? And again, for the VIPs, they're going to get access not only to the workbook, but they also get access to the different materials that I'm going through. Today, I'm going to share with you an option on how you can literally get access to, sorry, I've just got more and more testimonials coming through. Anyway, I think you get the point. Today, I'm going to give you, later we're going to talk about what we call our 30-day passive income challenge. And it's something that we put together in October last year. And my partner, Shane, said, the problem with most people is that they're busy and there's lots of things going on in their life. And imagine if we could get them a passive income within 30 days. And so we worked really hard to put together a challenge so that we could help someone go through 4 simple steps to be able to get their passive income in 30 days. And I'm going to share with you later how you can actually get involved in that. I remind you of whether you're in the right place or not. Jordan came, he was a high net worth, 55-year-old, wanted to build his portfolio and ensure his wealth was protected. When he came to us, he wanted passive income. He wanted to, do it simply and safely. He wanted to diversify across countries, currencies, and assets. That's exactly what we're going through today. He wanted to get effective results with predictability. He wanted to get the right knowledge for him and his family. He wanted to have wealth protection, a plan B, and peace of mind. He wanted to be held accountable. Anyone who's successful knows that accountability is critical. He wanted to have a family office to help manage all his affairs. He wanted to create generational wealth for his family. He wanted to have a full-on wealth plan, an investor strategy sheet, and he wanted to get results. And if you resonate with Jordan, then you're in the right place. And Victoria, a lady in her 50s who built her family and business and was aiming to build generational wealth. She was very, very busy and she wanted a streamlined investment strategy. She wanted to feel empowered to make the right decisions, and she wanted to set herself up for financial freedom. And again, if you resonate with Jordan or Victoria or both, then you're in the right place in terms of this process. So what are we going to do today? If you look at this, you basically got the countries, the currencies, the assets, the partners, and the time. So the way we're going to do this is that today we're going to be covering countries, currencies, and assets. Tomorrow, we're going to start looking at portfolio construction. So now you've got the understanding. How do you actually build a portfolio? On Thursday, I'm going to go through how do you find the right partners. And on Friday, we're going to build a plan over time. How does that sound to you? Is it starting to make sense? Do you start to see how it all sort of comes together? So there's 3 different layers to this, this formula. You've got residential property, houses and apartments. You've got commercial property, like offices, industrial building, medical, etc. And then you've got alternative assets. So for the purposes of today, I don't have time to go into the detail of residential, commercial, and alternative assets. There's just not enough time. So what I'm going to teach you is how to do it for residential property, because most people here understand residential property and or have invested in residential property. So let's go through it. Module number 1 is how to choose the right countries. How do you uncover the global market? Like, where do you invest? So let's have some fun before we get started. And our mission is to help investors get 100% clarity on where they want to invest and avoid the mistakes that 80% of investors make. So that's our mission. But before I tell you how I do it, why don't you tell me, where are the best places in the world to invest? Countries. Where are the best countries to invest? So just type in the chat box. Let me know. What do you think? Where are the best countries in the world to invest? Okay, so I can see the US in the country you live. Dubai, coming in nice and quickly. Hang on, let me go back here. Dubai, US, UK, UAE, America, China, US, London, USA, London, Dubai, USA, Australia, US, Australia, UK, Vietnam, India, Singapore, UK, UAE, Switzerland, Dubai, UK, US, South Africa, Australia, South Africa, Western Cape, Australia, UK, Mauritius, India, EU, India emerging, UK, Australia, New Zealand, Australia, US, South Africa. Wow, interesting. Shane, please make a note. Next time we should put up a poll here and see what everyone thinks. South Africa, UK, USA. Okay, so my point being is that everyone has given us fantastic insights into what they think as to where to invest. Now, I've been doing this for 28 years. And what's interesting to me is that, a lot of people make decisions based on gut feel, or they make decisions based on their friends and family, or their husband or their wife, or their financial planner. But what I think is really important is that you actually need to have systems. You need to go through models, and you need to work on fundamentals. So let me give you an example of what I'm talking about. If you know anything about Clem Sunter, so Clem Sunter, where's his book gone? Here it is. So his book, Thinking the Future. He also wrote Mind of the Fox, one of the top 5 strategists in the world, and and scenario planners, etc. And I introduced you to him yesterday. Now, I've done a lot of work with him. I've had the privilege of working with him. And when I wrote my book in 2013, he actually wrote the foreword of my book. And the reason being is that I came for many years and I watched him do this scenario planning. And for about 5 years, I watched him do the scenario planning. And I was like, wow, everyone's in this room, including me, and they're just listening. But what do you actually do with it? So I went away and I said, right, let's take his scenario planning and let's create a 4-dimensional model. And I always joke with people. I know I'm not normal. I appreciate that. But I created this 4-dimensional model because I said, listen, if we've got his scenario planning, how do we actually decide where in the world to invest? So let me give you an example. If you look at property, there are fundamentals to property. It doesn't matter where you invest in the world. So on the left-hand side, you've got risk. So risk versus value. Effectively, that's your risk return. Okay? Like that's your risk ratio. And on the right-hand side, you've got return. Okay? I hope you can all see my mouse. So if you take the fundamentals of property, the first is economic risk. What is the economic risk of the country? The second is, what is the value of the property discount? Like it's always, most of you would have heard it's good to buy stuff below market value. Then you've got the property fundamentals, and this doesn't change anywhere in the world. I learned this originally from Dr. Dolph Duras. You have to have population growth. So a good example of this in Japan, in the late 1980s, 1988 to be exact, Clem Santa talks about this, where the Japanese economy crashed and the property market has never ever recovered, neither has the economy for that matter. And the reason being is that the population is in decline. It's gone from 120 million to 100 million. If you take Europe or England, Clem jokes, if you put a roof on top of England, it'll be an old age home. You have an aging population, whereas somewhere like America has a growing population. Okay, India has a growing population. So what becomes very, very important is that you want to look at countries and you want to make sure that they've got population growth. And then when you get more micro, if you go to a city, you want to make sure that a city has population growth. A great example of this would be Atlanta in America, or Austin, or Texas, any of the Texas cities. They're some of the fastest growing cities in America. Whereas places like up north, where do they make the bloody cars? Just had a brain fart. Anyway, where they make the cars up north in the Rust Belt there. Like those, Detroit, thank you, Reg. Those cities are in decline. In fact, they've lost like 20 to 25% of the whole city is shut down. Now, that's a great example of a city where the population is going down and the chances are that property will not recover ever. I remember years ago when we started investing in America, 2011, 2012, there was a South African guy that was selling properties to South Africans. And he was selling them at a massive discount, like 25, 50% in Detroit. The problem is if property goes down, but the population growth is never going to recover, then you're not buying at a discount, you're buying at the new rate. And those people that invest in Detroit have never, ever made money. Supply and demand, like it's really important that you know how much supply is in the market and how much demand there is. It's simple, basic economics. You have to have more demand than you have supply. And if you have more demand than you have supply, then prices will continue to rise. But if you've got more supply than you've got demand, then prices will drop. A good example of this, in Ireland, in 2008, 2009, do you know that 1 in 4 homes that was built was standing empty? Now, if you do or don't know, but the Irish market crashed badly in 2008, 2009. That's a classic example where supply and demand is out of kilter. In 2008, 2009, when the crash happened in America, there were 10 million homes in America unoccupied. 10 million. And just in my interest, type in the chat box if anyone knows this. How many properties in China right now have been built and are unoccupied? Does anyone know? Jacqueline says a lot. Gary says 15%. So just to remind you, it was 10 million in America that created the global financial crisis. It's 60 million in China. So the last time I researched this, there were 60 million houses or apartments that have been built in China that were unoccupied. Very important. And then the last one is rule of law. Now, this one's an interesting one because people are like, but if you're in America, particularly if you're in one of the red states, and someone doesn't pay your rent, you can literally get rid of them in a couple of weeks. In fact, there's a thing called a put-out crew where they'll literally come and take the tenant's furniture and they'll put it on the sidewalk and everyone steals it, toughies for them. If they don't pay the rent, they get out of the property. In places like South Africa, it's extremely difficult to get rid of tenants. England is okay. It's somewhere in the middle. Australia, is pretty tenant focused, but there's very good protection in terms of, tenants never pay late because there's very good transparency around the quality of tenants. And there's such demand for property that no tenant wants to get on the bad side of their credit rating. So India as an example, I think there's massive potential in India, but you've got to be very, very careful with regards to property rights. And I know a number of people that own properties in India, but don't put tenants into the property. So these things become really, really important in terms of you understanding how to be able to do this. And if you take this all together, you ultimately get a risk index. Now, on the yield side and the return side, you can balance this any way you want. I've learned from over the years that the wealthiest people always invest for income. So you can see here, there's about 70% weighting on income and only 30% on capital growth. By the way, the middle class and the professional always chase capital growth. Oh, look, my shares went up. Oh, look, my Bitcoin went up, whatever. But the wealthy invest for income because income gives you freedom. So I've got a 70-30 weighting, and that gives you a return index. And what's interesting is that you plot that out, and this is what Clem Santa helped me do. And you can see here on the left-hand side, you've got low return, high return. And at the bottom, you've got low risk, high risk. And the ultimate is to be in this zone here, which is high return, low risk. Now, I've used the graph that I used in my book. So this is from 2013, just to be clear. Who would like to know where to get the information in 2025? Jacqueline says the UK will be difficult soon when the law changes. Yep, I agree with you, Jacqueline. So again, if you want to invest in England like a mom and pop investor or a retail investor, I think you're going to have serious problems, if you want my opinion. The way to invest in England, and you're going to meet Gary Sachs today, is to do it like an institutional investor. So let's go and look at some information here. So if I go, let me just get rid of that screen. And let's start off with this. So this is the best place that I've found for data. And what I love about it, it comes from The Economist. And what's really cool is that it takes all the data as far back as the data comes. So like right back to whenever the different deed officers started collecting data. So you can see it goes back as far as 1970. Now, what's fascinating here is you got real prices and you got nominal prices. So real prices take into account inflation, whereas nominal prices don't take into account inflation. So real prices take into account inflation and they show you how much growth you've had, and nominal prices don't take into account inflation. Then you've got the value of a property based on the income. So this becomes really valuable because, in any country, you want to be able to see, it's called the affordability index. You want to be able to see how much money someone is earning based on how much property prices cost. And depending on how much they earn will determine whether they can afford, where the property prices can go up. And the last one, and the one that is most important, is what is the value of property based on the rental income that you're actually getting. So this one becomes really important because if you're basing the property based on the value of the rental income, then that, whether it's residential or commercial, ultimately that's its real tangible value as an investor. Please understand, I'm not talking about buying homes. Like for me, a home is like my boat outside my house. It's an expense, it's a luxury. You buy your home, you do what you want with it. But the point being is that I'm not talking about homes here. I'm talking about investment and investment property. So back to those questions around what countries to invest, where to invest, what is the best country. Now it becomes quite interesting because we can compare, if we go back to real here, if we compare America and England, because quite a few people put the USA, if you take from the year 2000, okay, property prices are now 50% higher in America and 94% higher in England. That's in real prices. In nominal prices, it's 129% and 190%. Based on income, property in America is 6% overvalued, and in England is 28% overvalued. And if you take it based on rent, which is the one I think that's important, it's 15% overvalued and 39% overvalued. Now, if you go here, which is the model, and I'm going to show you later how you can get access to this model if you want it, you can literally go in and you can go to the country like the USA and you can put in like whether it's overvalued or undervalued, etc. So I've literally shown you where you can get access to the information. Now, just by the way, is this pretty cool? Like, do you like being shown where to get all the stuff? Maybe it's just me that gets excited. Now, what's important is that you can go and choose another country. I don't know. Let's go. There's like the top G20 here. You can go put in South Africa. By the way, you can see the huge growth South Africa had in the early 2000s. But you can see that South Africa is currently, according to Rent, is 3% overvalued, whereas the United States is 15% overvalued. What about what were some other countries that were there? Let's go look here quickly. Australia, 47% overvalued. What else? Let's just see what other countries were here. So it's interesting. The UAE is not here, and it's because they didn't have any data records until very recently in terms of that process. Now, what becomes also important, you can now compare like any country to any country. You can also go look at major cities. So like if you go to America and, look at the American market, firstly, if you're wanting to compare like New York or London, you can do the exact same thing. So you can go through all of the different major cities. So like we've got something in Manhattan right now, so if you're comparing kind of Manhattan to, boom, 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 you can see all the different cities that are here. So at the moment we've got New York versus London. You can see New York is 41% higher. London is 144% in real. And if you do it based on income, you can see that New York is 24% overvalued. London is 60% overvalued. So this becomes really interesting. And you can actually go down and play with this data. You can go to the American Cities Index as well. Just let it open up here. Oh, why is it not opening up? There it is. So America is a massive place. There's 300 cities in America. So, people always say to me, oh, I want to invest in Los Angeles or whatever. But like, as an example, let's just look at Atlanta here. So we've done very well in Atlanta. So if you were to compare, I don't know, let's just take San Francisco to Atlanta, okay? So in real prices, San Francisco is 111% higher, whereas Atlanta is only 12% higher. In nominal prices, 223.71. In income, 18% overvalued, 23%. And in rent, 1% undervalued, 21% overvalued. So now, do you think it's better to invest in Atlanta, or do you think it's better to invest in San Francisco? What about Phoenix? Another city that we're investing in. Okay? Just as a matter of interest. Can you see how powerful this is once you got access to the data? And now you just go and plug the data. So I created the model because, and by the way, no model is perfect, but you can see that at least if you got a model, you can compare apples with oranges. And if you do this, you can actually see at the moment, based on the last research I did, was that the two places that are in high return, low risk are currently America and India. You can see Australia sits there, Germany, Canada, France, UK, kind of all in low return, low risk. Japan, low return, high risk. South Africa, high return, high risk. It basically gives you a model. Remember, this is residential. Oops, no, sorry, this is residential. Interesting enough. Sorry, so that's right. So in residential, nowhere is sitting in high return, low risk, because I just showed you there's properties are overvalued, etc. But you can actually do this for residential. You can do it for commercial. You can do it for alternative assets, and you got all the workings. Okay. Let's just do one last because someone asked for Portugal. I did see Portugal here. And we're not going to spend all day. So Portugal is 8% overvalued. And if we go Greece, 3% overvalued in terms of that process. Okay, now some more data that I think is important. If you're going to invest in England, the place to go is a place called Academimetrics. So you can literally go and get all the information, all the latest reports. This comes from the deeds office. So it's the best data. There's 7 indices in England, but this is the best one by far that you can go and see what's happening. You can literally download all of their reports every single month. it comes out with an illustrative report on what's happening in the markets, etc. So you can literally go, you see this house price tools here. So you got the house price index, and you can literally just go and read every single month, like what is happening, where do you need to invest. If you want to know anything about UK property, this is the place to find it. This is how I learned. I've been investing there since 2002. This is how I learned all about it. So you literally, if you just click on this press release as an example, you see how you get a full summary based on the market, what's happening in the market, all the different areas, the growth, everything, supply, demand, everything you need to know is here, and it's on a monthly basis. In England, you've got the in America, you got the S&P Core Logic, Case-Shiller. In Australia, it's also Core Logic. This used to be RP Data, but they got bought by Core Logic. So you can see here, this is all the same stuff in terms of Australia. And in South Africa, you got the F&B Barometer. Just by the way, when I wrote my book, it was the ABSA Housing Index. Now it's the F&B Barometer, where you can go and get access to all your information. So that basically gives you this. Now, what we evolved is we evolved what I wrote in the book into GIDS. So GIDS is a 10-layered system where it actually starts to look at currency movements. It looks at macro, like what countries to invest in. It looks at how to find the right partners. Then it goes down to the city. And for all the reasons I've just told you, you've got the city and how to look at the city. Then you look at the property and actually analyzing the property. Then you've got to manage the property, etc. And there's 10 different layers through this whole process. Now, I just want to go back to the resources that Shane kindly shared with you. And if you go back here under day 2, when you get the recording, Shane will actually share with you some of the links that you can click on. But I will show you in terms of how you can get access to all of this training. And if you go here, and I'm going to show you, I'm going to talk to you later about Wealth Going Global. But if you go to the classroom and you literally go to Wealth Going Global, you'll see here that we literally teach people. Like if you go to this one here, Uncovering the Global Market, you've got a link to everything. So the presentation, the calculator, all the different graphs around population. You've got all the Clem Sunter stuff. And then you've got all the stuff around the countries, the USA, growth. This is how to find the population and even the rule of law. So I've literally made it easy for people. I've shown you where to go and get the information on an ongoing basis. Nirvana, yes, I do pay subs for The Economist, but I think you're allowed 2 or 3 articles a month for free or something. Okay, that's countries. Let's go to currencies. The currency conundrum, managing risk in a global investment. So the mission here is to help investors diversify their portfolio and mitigate risk by investing in multiple currencies. Now, again, when I wrote this book, I thought, well, if you're going to invest around the world, if you're going to be a global investor, you need to have an index. So I basically created the Global Wealth Index, which is very similar to CPI. So, you know, in any country, you got CPI, the Consumer Price Index, where the government basically has a basket of goods and it determines whether prices are going up or down. It's basically how they determine inflation. They do it with a basket of goods. So it's just a standard, the principle is just a standard basket of goods that they copy over and over again. So my logic was, well, if you're going to be a global citizen, why don't we do the exact same thing? So I took a family holiday to Disney World. Any parent really wants to take their kid to Disney World. A skiing holiday in France, a private school education in Australia, sending your kid to Harvard University, and immigrating to Australia or America. And you'll notice what I've done there. I've had a basket of goods between England, America, Europe, Australia, a mixture of things between holidays and tuition and immigration, etc. And the point is, it doesn't really matter what you put in it. It's just comparing how things change. Now, again, you can go to the Global Wealth Index as the calculator, and you can calculate between any currency anywhere in the world. You can go, you know, do the Singapore dollar and the US dollar, whatever. I'm originally from South Africa, so I like to look at like the buying power of the rand. And if you look at it here in 1983, 1993, 2003, 2013, and 2023, there's been a 92% decline in the buying power of the rand. It's quite phenomenal, actually, in terms of that process. Now, it's time for me to do an upgrade on Wealth Going Global, and I'm really excited to be sharing with you that I'm going to be redoing it starting the 22nd of July. And when I go through this, I will update all these graphs and all these metrics. But when we do the currency, I work with a partner called James Painter. So if you take, again, this book, he wrote chapter 2, and James Painter went through in detail around what do you need to know with regards to currency. So what are the hidden engines behind the markets? What are the exchange rates that you need to adjust? And if you look here again, I don't think you need to understand all of this stuff. All I think you need to do is know where to find the right information. So if you go to James Painter, he basically has all the different forecasts. You can see the dollar rand, and he basically does it in a short term, medium term, and then right through to long term, basically, in terms of the process, the long term outlook. Now, I know these type of graphs tend to scare people, but what's really important here is just to kind of see where the targets are and then also what the probabilities are. And now, as an investor, we're not really interested in, what's going to happen in the next day or two. You should be thinking what's going to happen in the next 5 years, because it's long-term trends that we're most interested in terms of what we're trying to achieve here. And so we use this in terms of the different currencies. What this allows you to do is you can do all the different dollar, euro, pound. He's got different services that I subscribe to, where you can do commodities, you can do the stock market, you can do cryptocurrency like Bitcoin and everything else. And what he does when he takes you through this course here in terms of, oops, sorry, wrong one. When he takes you through the course here with the currencies, he literally takes you through all of the different things that you need to know. And he also gives you access. You can see you've got access to my global wealth index and everything else. So you've got access to understanding exactly where are the currencies and which currencies to invest in and why in terms of that process. Now, if you go to mine, and I'm wondering actually how I can find this quickly. Shane, do you know where my investor strategy sheet would be? The download. Nope. Okay.
Check in the university, Scott. Sorry, in the school. Yeah, just search for it in there. Scott, can we try and switch to your usual normal mic?
This is not working.
It's a little bit muffled on that mic today.
No problem. Okay. Just make sure the audio is working out. Okay, you should all be hearing me now. It's just coming straight through my laptop. Okay, so as an example, if you take the currencies at the moment, you would be looking at, again, listening to James and them. You've got things like the dollar. The euro is expected to increase against the dollar by kind of 30 to 50%. You've got the pound. You've got the Swiss franc. You've got Bitcoin. And all of them are there to kind of help, give you some guidelines so that when you go and you choose your sheet here, and that's why I was just looking to bring up your investor strategy sheet here, and you fill in your countries, you can literally, there are different rankings that you would have for your residential, your commercial, and your alternative assets. And then when you finally come to here, which is for your currencies, you've got the dollar, the euro, the pound, the Swiss franc, Bitcoin, etc., as the top currencies to kind of invest in. Now, the next thing that becomes important is how do you actually choose the right assets? Building your global portfolio, selecting the right assets for your investment. So in this module, it's about helping investors find the top 15 assets that they'd like to invest in without losing money and spending decades of time researching them through trial and error. So you know where 15 comes from? We copied that from Ray Dalio. Now, the question for everyone is, okay, cool. Just in future, if you're struggling to hear me, I've got a brand new studio set up here, by the way. So I'm learning how to use it all. And if you're battling to hear me or whatever, just tell me and I can adapt in terms of that process. So what I'd like to do now is go into the asset classes. And I went and researched with my partner the top 15 most commonly recognized asset classes. So let's just go through what you would sort of understand as all of the top 15 asset classes. So the first one is stocks and equities. I mean, that's where you own stocks in a share in a publicly traded company. Bonds, which are debt securities issued by governments, municipalities, or corporations. Real estate, physical property, including residential, commercial, and industrial. Cash and cash equivalents. So this is highly liquid assets such as bank accounts, money market funds, treasury bills. Commodities, raw materials or primary agricultural products like gold, silver, oil, natural gas, wheat, corn, etc. Mutual funds. So these are pooled from multiple investors used to invest in various securities. Exchange traded funds. So they're similar to mutual funds, but traded on stock exchanges like individual stocks. Derivatives. They're financial contracts derived from underlying assets such as options, futures, and swaps. Currencies, so that's trading one currency against another. Private equity, so that's ownership in private companies not traded on public exchanges. By the way, a public exchange is like the New York Stock Exchange. A hedge fund, investment vehicles that pool capital from accredited investors to employ various investment strategies. Venture capital, investing in early stage companies with high growth potential. Arts and collectibles, valuable items such as artwork, antiques, rare coins, or stamps. Cryptocurrencies, digital currencies like Bitcoin, Ethereum, and others. And infrastructure, investments in essential systems such as transportation, energy, and utilities. Now, I don't have a lot of time today, but I do want to just give you a high level of what the difference is between the primary and the secondary market. So if I stop sharing here quickly, just so you can see me better. Does anyone here know what the difference is between the primary and the secondary market? Just type in the chat box if you do. In the meantime, I'm going to have a drink of water. Okay, so I can see a couple of no's coming through. So in simple terms, let's start with the secondary market. The secondary market is the stock market. So it's where you can go to the stock market. It might be the London Stock Exchange, the New York Stock Exchange, Johannesburg Stock Exchange, the Sydney Stock Exchange, whatever. And you can go there and you can trade shares in companies and lots of other assets. So that's called the secondary market because you basically go there and you can buy stuff through the exchange. The primary market are actually physical assets, so they're not on an exchange. So this property, as an example, is part of the primary market. Okay, and the alternative assets like commercial property and things like that generally are in the primary market. So they're held privately and they're not on an exchange. Now, there's pros and cons to both. The secondary market is very liquid. You can, if you got shares in Apple, even if the price plummets, you can still sell them. I mean, again, it's willing buyer, willing seller, but you can generally always sell them. There's always a buyer. There's always a price at which someone will buy it. Whereas in the primary market, they're a lot more illiquid. They don't move nearly as much in terms of being able to sell them. Now, that can be a con, but it can also be a pro because the secondary market is very susceptible to volatility and basically based on people's sentiment. So when people get scared, they sell. Whereas in the primary market, because things can't move quickly, they're nowhere near as susceptible to sentiment in terms of that process. So something we're going to learn about tomorrow is that the wealthiest people, the top 1%, have more than 50% of their portfolio in the primary market. More than 50%. And I'm willing to bet you that you don't even have 10 or 20% of your investments in the primary market. And that becomes quite scary because that's a problem. So tomorrow we're going to go through asset allocation, but it becomes really important to understand what the difference is between the primary and the secondary market, because your financial planner is going to put all of your investments into the secondary market because it's easy, it's generally deemed to be safer, and they can earn fees off you in terms of that process. Now, the next question is why no residential? So I go on and on and on about this, and I've helped 2,500 people buy houses. I told you yesterday, I've owned 16 properties myself. And across the world, I noticed a pattern. And so when I say no residential, all I'm saying is that I don't want to invest like a mom and pop investor. Like, as an example, let's take London. If you take London, if you've got up to £1 million, every person is out there going on a property course, trying to become a property investor. There's massive demand for mom and pop investors wanting to buy a little house or a little apartment and rent it out. So there's a massive, like the market's very saturated. If you have more than £1 million and you start to invest like the top 1% or like the institutions, you get out of the rat race. You get out of the moms and pops. You get out of the saturation. And now suddenly you find yourself in a space where there's actually really good deals. And those good deals tend to be even safer. Let me explain to you why this is, because you've got a thing called the real estate value chain. Now, if you take a typical system, so this is you, the investor, and you want to invest in a house or an apartment, there are 16 different middlemen between you and your investment. Okay? I'm being kind. I'm only showing 4 or 5. There's no trust. There's no transparency. And because of the high fees and low returns, there's no alignment. Now, if you take this value chain of real estate, you'll understand why houses and apartments generally don't make a good investment, because you're at the bottom end of the value chain. So if you take land zoning, this is the first step. So this is when there's a farm and someone goes and gets permission to turn it from greenfield into brownfield, which basically means they're allowed to do development. Then a developer comes along and they build a vertical structure. Then an investor comes along and they put a tenant into that structure, which basically earns an income. Then basically the way they make money is they then go and sell it to a fund or a REIT. That's where the most money is made, in that period there. And then it gets listed on the stock market, and then a financial advisor helps you invest in it. That's the way it typically works. Now let's look at the returns. The average land investor is looking for an IRR of roughly 30%. I'm not saying they always get it, but that's what they're aiming for as a target. The developer is looking for 25%. The investor is looking for 20%. The fund or the REIT, well, they're buying income. And if you take your pension, what do you want in a pension? You basically want, come on, tell me, just type it in the chat box. What do you want when you have a pension? What do you want from the pension to give you? What is it? Money. Income. Yep, it's income. Money, income. It's basically income. So what do? They buy stabilized income. So they buy an income of generally, it's called stabilized rent or stabilized income. And they basically buy it generally between 5 to 8%. And then you and I come along and we wonder why we battle to beat inflation when we're getting returns of kind of 2 to 6%. Now, if you understand this value chain of real estate, and again, if you want to go to my LinkedIn profile and literally search for how wealth is created and what billionaires do, because there's an entire article on this where it's from one of the financial newspapers, where literally there was this company called Robosis and the Billion Group was the developer, and they were literally building this, all these shopping centers, and they were filling them up with tenants, and then they sold them to the Robosis, which was the fund, and the whole article was how it was overvalued, but then all the retail investors invested through the stock market. What I think is not right in this situation is that the Billion Group and Robosis was owned by the same person. So when you look at the value chain of real estate, the question I always have for people is, why don't you go up the value chain of real estate? Why don't you invest at the investor level and actually own quality first world assets like the top 1%, commercial real estate, industrial real estate, etc.? Why don't you become a developer and actually do developments, etc.? And the feedback I get from people all over the world are things like, how do I protect myself? It sounds too good to be true. Compliance, management issues. I don't have time. I need the right structures. There's too many scams. How do I get access, etc.? But ultimately, it comes down to 3 things. I don't have the money, I don't have the knowledge, and I don't have the time. And so I want to be able to solve this for you. And my wish for you is that in the next 3 days, I will show you how you can invest, whether you got the money, whether you got the knowledge, or whether you got the time. Is that fair? And I started with this analogy yesterday, because if you remember, I showed you the analogy of the private driver and the smartphone. Because now, because of technology, all of us have a private driver. We've cut out the costs, we've cut out the middlemen, we've increased the trust, the transparency, and the accessibility. So using technology now, you can literally go up the value chain. You can invest at an income level, and you can invest in assets that are literally paying you a quality income, or you can go in the growth and get involved. Like right now, we've got an opportunity in Manhattan where you can literally invest alongside a developer in Manhattan, and you can benefit both from the income plus the capital growth in terms of that process. Now, the next slide, I would strongly recommend that you take a picture of this. So what I'm going to share with you is what don't we do? So let's start off with this, and I call this the 8 golden rules. The first is that we don't do assets where you need to pay an expert. Okay, so it's, if you've got something that's like super complicated and you don't understand what's going on, like I don't want to do assets where I need to pay an expert just to understand what I'm doing. And a good example of this is what I showed you yesterday. Like the stock market on average is giving you 9.5%, and the average investor is getting 3.6 on their own. Assets that have no income, generally they're less part of timing. So I like to focus on assets that have income. We do some assets that don't have income, but then it would be part of our overall plan around timing. Assets which are short-term, volatile, and high maintenance. So again, I'm not saying this is wrong, and if it works for you, fantastic. But for me, what I don't want to do, I don't want to do day trading or crypto trading or something like that. Because while I'm talking to you right now in the last hour, who knows, the market might have crashed, I might have lost all my money. I don't like it. I prefer owning businesses and property and private equity that's kind of long-term, and I can sleep well at night. Assets we don't understand. So futures and swaps, I don't know, maybe they're good investments, maybe they're not. I don't understand them. I prefer to stay away from them. Assets which mom and pops do. So this is an important one. Like if there's loads of programs on this, and like I just said to you, you can go to a property investment seminar in England every single weekend, and they'll teach you how to be a property investor and make £1 million. And my philosophy is it's a very crowded market full of mom and pop and retail investors. I want to get out of that, and I want to be in an uncrowded market. Assets where we don't have the right information. So a good example for me would be Dubai. I think there's huge opportunity in Dubai at the moment, but it's very hard to get access to the right information. The market's quite new in terms of information. There's been lots of ups and downs, lots of crashes, and it's quite hard to get access to the right information. Assets where we don't have the right partners we can trust. So a market here would be India. I love India. I've been trying to get into India since 2017. I've been to India multiple times, but it's all about finding the right partners on the ground that we can actually do deals with. Another one would be Vietnam. I think there's huge opportunity in Vietnam, but I don't know. I haven't been able to find any partners there. And then assets in countries we don't understand. I learned this originally in China. So I was in China in 2003, and I actually went there to buy property. So I literally went to Shanghai to buy property. I'd learned about it in London. I thought that really makes sense. I want to go and buy property. And what was so interesting to me was in 2003, like that, virtually no one spoke English. And in Shanghai, I really struggled to even buy a plane ticket. So I was trying to fly from Shanghai to Bangkok, and I literally really struggled to buy a plane ticket. And I was like, how the hell am I ever going to buy property? Like, I'm literally going to get swindled here, guaranteed. And look, it's a pity I didn't, because property's gone up 4 or 5 times since 2003. And if I'd got it right, I would have done really well. But I just, if you can't buy a plane ticket or you battle to buy food, the chances are you're going to battle to to win. And I fundamentally believe in those days I was trying to do it all myself. It would never have worked. If I'd found partners on the ground, that would have been a different situation. So the way to solve this always is through partners in terms of that process. So taking that into account, what don't we do? Well, we don't do stocks and equities. By the way, through our family office, we can help do that, but we don't do that. We don't do bonds. I don't really see the point in lending money to the government. It's like lending money to a friend that's a bad payer. Like, you wouldn't keep lending them money. We do real estate. We don't do cash and equivalents. We do commodities. We don't do mutual funds. Ray Dalio, Jim Rogers, all of them went on and on about why not to do mutual funds. We do exchange traded funds. It's, by the way, Ann Wilson, who you'll meet today, is an incredible lady, and she's got the easiest way to actually get involved in the most cost-effective way through the stock market. We don't do derivatives. We don't do currency. We do private equity. We don't do hedge funds. We do venture capital. We don't do arts and collectibles. I know my partner, Alex, wants to, but we haven't found a partner yet to do that with. We do cryptocurrency, and we do infrastructure. And so if one was to look and say, right, what is our top 15 focus? Well, the first one is commercial real estate, multifamily. So this one's an interesting one. So you basically got multifamily. So multifamily is where you buy the entire building. So yes, some people would call it residential, but in America, if you own 4 or more apartments, it's not deemed residential, it's deemed commercial. And this has been the best performing asset, risk-adjusted return, since 2010, since the crash of 2008, 2009. And so multifamily. The next is industrial. So this is where you buy industrial or industrial logistics, but it's basically commercial property. MOB, medical office buildings. Office, I think that's self-explanatory. Co-living. So this is like, you've got student accommodation, and then you've got upmarket accommodation specifically for kind of 25 to 40-year-olds that want to live in social environments close to the city center, close to amenities. It's been one of the most investable asset classes from the institutions over the last couple of years in America and in England, and recently in Australia. Commercial real estate, London residential, but large scale. So today you're going to meet Gary Sachs, and I'm going to teach you how to not invest like a mom and pop, and actually to do this at an institutional level. First mortgage debt. So the banks are becoming more and more difficult to lend money. So now one of the fastest growing asset classes around the world is actually providing debt. You just like the bank. Retail. So that's obviously retail shopping centers. By the way, in retail, I don't want to buy big shopping centers that are going to get taken out by e-commerce. Like, you want convenience stuff. So you want stuff where people are going to buy stuff because it's got longevity based on long-term trends. Senior living and aged care, fairly self-explanatory with the aging population, particularly in the first world. Mixed use. So this is what we've done in Germany, where you've basically got different types of assets or different types of usages in the building, and you've got multiple uses. Data centers. This is an incredible one. So I'd really like to get into data centers. We've actually really struggled to get into data centers. And we did a talk for our mastermind members. It's really phenomenal. This guy has invested about $5 billion in data centers. And he said to us, the problem with data centers is that the demand is doubling every 6 months. So the demand is doubling every 6 months for data centers. Think of all the crypto and the big data and the AI and everything else. So the demand for data centers is doubling every 6 months. But the supply is constrained because of the amount of power it takes to run a data center. So you've got supply constrained and you've got demand doubling every 6 months. That's an opportunity. ETFs and the stock market. So exchange traded funds and the stock market. Structured notes. So this is an interesting one. And for those in the VIP, remind me today, I'll take you through more what a structured note is. Now, an interesting story here. In 2019, one of my top investors came to me and said, Scott, are you invested in structured notes? And I was like, what's a structured note? And I've got all the degrees, and I've got all the experience, and I'm supposed to know what it is. I've never heard of it. And he went on to show me that, like, you've got retail banking, then you've got wholesale banking, and then finally you've got institutional banking. And at the institutional level, as long as you've got $2 million or more, then you get access to structured notes. And I mean, as an example, if I was to go here and quickly log into Wealth Migrate, you know, we've had structured notes on our platform that get the most amazing returns, all in double digits in pounds and dollars and euros. So if you go down here, and if I just look down to some of the ones we've done in the past, you know, this one here, 10.13% return. This one here, 15% return. Just looking if we've got any more. Another one here, 12.34% return. I think you get my point. And I actually got quite pissed off because I was like, wow, there's an entire party going on here that I was never even invited to. Gold and silver. You know, I was recently with Robert Kiyosaki, and he goes on and on and on about gold and silver. Again, at our mastermind level, we've brought in an expert to teach people on gold and silver and how to participate in that. Private equity. By the way, we're going to be talking about this more on Thursday. You're going to be meeting the head of our private equity team, and he's going to be teaching you about how to find the right partners around the world. Venture capital. So this is where you invest in more early stage companies. And then finally, crypto. So Ray Dalio said choose 15 assets which are uncorrelated, 15 quality assets. On the screen there, you got 17. So my strong recommendation is screenshot that and then pick what are the top 15 that you're going to want to focus on, because that is the homework assignment. Over here is you want to go through the countries, you want to go through the currencies, and you want to go through the assets and actually fill in the assets, your top 15 assets. And can you believe it? Most people didn't even think there were such a thing as 15 quality assets. Now, we've got a program which we call Asset Class Mastery. And if I go back here to the classroom, you can actually see that each one of these assets that I've just mentioned is actually here. So let's just take structured notes as an example, or what's another one I spoke about? Data centers. And you can literally go through all of them. And what's so interesting here, people are like, oh, but I know what a data center is. For me, this is not only the information, this is about meeting the right partners. So what I'm really good at is, having done this for 20 plus years, I know how to go and find the right partners. And I'm not interested in a Harvard professor trying to teach you about an asset class. I'm interested in someone who's actually doing it. Like in the data centers, this team, this gentleman had done $5 billion worth of data centers. And for me, those are the type of people you want to be listening to, because they're going to teach you, you know, not only about the asset class, but how you can participate in it, and most importantly, how you can partner with them. So before I go any further, just give me your comments on where you're at, because we've been through, you know, how to find your top 5 countries, how to find your top 5 currencies, and how to find your top 15 assets. And Christelle said I did a post on data centers on school. Fantastic. Thank you, Christelle, in terms of that process. And can you see with Asset Class Mastery, if I share my screen here again, can you see how you've actually got everything at your fingertips? It's all here. You know, if you want the right information, you literally go in here and you go to Wealth Going Global, because this is all about the right information. And if you want the right partners, then you basically go to Asset Class Mastery, and it's all about the right partners. And you can literally go through all the different assets and you can see who the right partners are. But what I wanted to do is I wanted to introduce you to an amazing man. His name is Gary Sachs. And it's interesting because this building here is the tallest residential tower in London. And Gary is a gentleman that I've known for a long time. I've worked with him since about 2007. And he tells his story now when I do the interview with him. But when you're listening to Gary, do me a favor and listen for 3 things. So again, this is that moment where you take your pen and your piece of paper out and you listen intently. Don't try and go and be on Twitter or Facebook or emails or whatever, WhatsApp. This is the moment to really take notes deeply as to what Gary is trying to teach you. Because what Gary is going to share with you is how to invest like the top 1%, how to invest like an institutional investor, and not like a mom and pop. And I'm going to share with you now this interview I did with Gary, because it is so important that if you truly understand the difference between investing like a mom and pop investor and the low returns that you get, plus the high risks that you get, and all the hassle, versus investing like an institutional investor or top 1% investor. And the whole time, just think to yourself, imagine if I could partner with Gary. Imagine if Gary was my partner. Do you want to run around England, just to use an example, or London even more specifically, and try and find your own properties and buy them and renovate them and manage them? Or do you want to just partner with Gary? I spoke to you yesterday about how to make money while you sleep. Now, listen to him and decide where you would rather have your money investing. And so let's hand over to Gary. And I really hope that you take lots of notes here, because Gary is an incredible man and he's got some incredible lessons to share with you. Gary, it's wonderful to have you online. Thanks for jumping on. It's always a privilege and a pleasure to learn from people that are on the ground doing it. I always joke with people, we could bring in Harvard University professors and, London Business School economics professors, and they tell us all the rhetoric about what's happening in the market. Or we could do it with someone that, owns hundreds of millions of pounds, has developed billions of pounds, and probably has a better pulse on what's happening in the market. So do me a favor, give us the précis version of your story, how you got to London, and how you ended up being one of the biggest developers in London.
Well, not one of the biggest, but we've done okay. So I left South Africa in 1987 when I was 2. No, I'm kidding. I finished university. I went to Wits, came to England, actually started a little furniture shop. And kind of instead of waiting for customers to come in, I went out looking to all the estate agents. Furniture, and just a little bit of history of you own the furniture. So in other words, if the tenant owned the furniture, it was difficult to get them out because their goods and chattels were there. So I kind of transitioned from there to kind of being in the early 90s, was a bit of a property boom. And slowly but surely, I started buying a flat here and a flat there and turning them, and et cetera, and selling them. Until that went into developments, and we'd buy a whole development, as you talk about, but we didn't hold them. We didn't have the capital to hold, so we kind of flipped them. It was much easier in those days in terms of getting mortgages, et cetera. And then we kind of transitioned into saying, you know what, why are we selling this stuff? Can we not keep it? And most of the time we've used our own capital and made it sweat and built up a business that today we are holding nearly 1,000 units with another 300 in the pipeline. And really the basis of this is, I'm sure a lot of you on the call know Natie Kirsch. And in 2009, it was impossible to get debt. And we had a development going up just to the east of Canary Wharf at the Excel Centre where the cable car is. And Natie funded me, and he said to me at the time, he said, Gary, he said, I'll go into this deal. He said, we've checked you out. We think you're honest, etc. He said, but he said, I don't know how clever you are, but even stupid people can make money in property. He said, just don't sell it.
Sorry,
and that's very key.
Just repeat it there. Sorry, because I know you well, and you drop these little gems in and people miss them. So just remind everyone what you just said there from one of the wealthiest people in the world.
He said to me, he said, Gary, I'm not worried about doing this deal with you because even stupid people can make money in property. Just don't sell it. Which is great. You have to generate capital to keep on building. So, you can get to a point where the market gives you a lot of luck, or you can create equity by, for example, planning plays where you buy a piece of land and you get a planning permission, etc. It's just the higher risk stuff that creates equity. And then you've got imputed equity. And that's how we've done it up to now. And in fact, now we're kind of looking at external capital to come in and to fund us. And that ultimately is where we're going. So you have to understand there's been a transition in England. England's famous for saying, your house is your castle. And that's always been, people always trying to buy their own property. Just to give an idea, in England, home ownership sits at about 65% of the population, which is enormous. That is absolutely enormous. But what's happened, and it's happened in the world, is as costs have gone up and as prices have gone up, it becomes more and more difficult to buy properties. It was easy up to the financial crash in 2007 because credit was available. As credit tightened up, it became very, very difficult to buy property. So there's been a transition to rental property. Now, that really comes down to the credit markets, because if you think about it, rent is the ultimate form of credit. Okay, so, if you go back 60, 70 years ago, the consumer credit was really on cars. And that was because the car manufacturers making a huge margin. How do they get more cars sold? Is they offer credit. Okay, so and as long as and then they're actually making money on both sides. They're making money on the margins of the cars and on the credit. So what's happened in England is as prices have gone up, credit has tightened up, the rental market has increased. Plus, I think it's included as a general world position of more of a nomad generation where people want to be flexible, want to move. I would guess that out of choice, people would prefer to be homeowners, but they justify being rentals, being in a rental because they kind of think it's kind of trendy, etc. And you can kind of get more value. What you don't have to do is invest in a massive deposit. So actually, over a life cycle of someone that is renting on a cash flow basis, it probably works. If you offset the additional rent you're paying to what it might cost you on a mortgage, and you take the cash flow of the deposit, it's probably about break even. But what that's created is it's changed the rental market in the UK quite dramatically. So from moving from single, maybe a portfolio of 4 or 5 units, as people see as a pension for themselves, which, as you alluded before, starts becoming a nuisance to run. And that's mainly because if you have a portfolio of 5 and one tenant doesn't pay rent, you've got a 20% hit on your portfolio.
Well, even worse, most international investors have a portfolio of 1, and then if that tenant doesn't
correct.
pay,
Correct. So Scott, if you go back a few years, we kind of pioneered rental guarantees.
Yeah.
And the reason we did rental guarantees was not so much and this, by the way, is when we were selling stock. And the reason we did rental guarantees was not so much to get better prices on our properties. It was to give the confidence, to buyers that they knew their cash flow was secure. And so if you think about it, we had a development of 100 units, and Joe Bloggs bought 1 unit, and Dave Smith bought a 2nd unit. One of them would rent out first, and one of them would rent out second. One of them may have a tenant paying or not, etc. So if you do that over 100 and you consolidate that on, say, a rental guarantee position, that risk is reduced dramatically. Okay, so and reducing the risk, and what you really want is investment in property. You've got to understand property is a long-term investment. If you make money on property in the short term, it's because you're lucky with the market, and you can't predict that. You have to actually be lucky. Again, you can take certain factors, which is what we're doing, and kind of use those factors to your advantage. So just for example, like we're noticing now, there's a huge lack of supply. So one can turn around and say, well, if you look at a macroeconomic position.
Well, if you don't mind, I'm actually just going to chuck up a slide of yours from when you presented in August, just while you're talking about this, just so people can actually see what you're talking about.
Oh, okay, fantastic. Okay, so we've kind of adopted a kind of a macro policy on the basis that you've got to look at 10, 15 years on property to really get your income. Otherwise, you create a market risk. And we kind of saying, well, use what we understand to reduce that risk. We're all about risk reduction on the basis that even stupid people can make money in property, just don't sell it over the long term. Okay, and don't get me wrong, if we get offers on properties that are fantastic, we will sell, but our preference is not to. And also, by the way, you reduce a lot of frictional costs, but I'll come back to that. So we take the macro philosophy on property and say, well, demand is restricted. So if you think about it, what we've gone through since 2007, we had a financial crash. The markets really dipped, but they came back quite strongly because there was a huge wedge of cash waiting for a dip market. And we had a good run between, say, 2012 and 2016. We kind of then started tightening up. Then COVID came, reduced construction. No new developments were really started during COVID. We finished a 700 unit development throughout the period of COVID. So we were very fortunate. Cost increases went up dramatically. So viabilities that developers had done stopped working. We then moved into this high interest rate environment. And for those of a similar age to me, which are probably not that many of you there, but, I lived in South Africa at one stage with 25% interest rates. So the generation that exists now is very used to low interest rates. I don't believe interest rates are going to drop for another 2-3 years. And I don't think we'll see for a long time that 1-2% positions. So that has dramatically stopped supply. It's particularly in London. And by the way, Scott, as you know, we're London-centric. Okay.
Yeah, well, I was about to pivot. Once you finished on the fundamentals of supply and demand, I was actually going to pivot to this one of why London, because again, it's one of the capital cities of the world, but I'll let you talk about it. But ultimately, I don't think there's many investors that don't want at some point say they own a piece of London.
Yeah, look, the benefit of London is the stability of the legal system, okay, or of England as a macro. As a micro, everybody really wants to be in London and England. If you look at the demographics of the country, there's this huge kind of swathe up north, etc., and there's this kind of leveling up policy. But the truth is, people live out of London on the whole, in places like Birmingham or Manchester, because they can't afford London. And what you're finding is London is equalizing with those areas, because there's been a bit of a boom in Birmingham, Manchester. But what you find is in a down market, and that's how we plan. We plan for a down market. So if we can't make something work in the bad times, we don't want it. Okay, so and so London is pretty strong, and the shortage in London is dire. So just to give you an idea, London needs about 60 or 70,000 new units per annum. And I think like the average over the last 5-6 years is probably 18, maybe 20,000. So it's created a real shortage. That's when Scott was talking about co-living. So co-living is happening. There's what can happen is you can get smaller units. So what happens, you get like a unit going, an average unit, say 650 square foot, 700 square foot becomes 300 square foot. The only problem with a unit like that is you can only sell it for the income. You can't get any capital growth because you can't split it. So you have to sell it as a building. What we've opted to go for is a mixture between the two. So we are taking regular blocks, which can be split up, but consolidating them. And the theory behind that, having dealt with the macro side of why we're doing it, the theory is, how do we reduce frictional costs? Okay, so when you're a developer, you're going to develop, and if you take your cost, the general margin, profit margin for a developer is between 20 and 10%. Okay, so let's just talk, say, 15% profit on the gross development value, the GDV of the development. So as a business, if we can be vertically integrated, that 15% margin is we keeping. Now you take out the frictional costs. We don't have sales costs. That's going to cost the developer 5% of any development. We don't have further stamp duties, okay, to hold the stock. So if I sold an individual property to an individual investor, they're going to be paying me my 15%. They're going to be paying 5% of the cost that I've had added on for sales costs. They're going to be paying stamp duties. It doesn't take you long to get to 18%. And then when you take the margins at 18%, that's quite a big difference. We also in an environment, obviously, where we've got increasing costs, okay, and a limited land supply. So for anybody that understands basic economics, sorry, if you don't mind, I'm just going to close the door because my dogs are going crazy. Just bear with me.
No problem. So just a couple of things to simplify what Gary's saying. In simple terms, when he's talking about cutting the friction costs, what he's saying is just cutting out the middlemen. And if you remember where I showed you the value chain of real estate, I said you could be investing at the end, which is what Gary's just saying, with all these costs all the way along, and that dilutes your return. That's why you never get out of the middle class, because your returns are middle class returns. Or you can go up the value chain, cut out all the middlemen, and that's exactly what Gary's talking about.
And of course, by the way, Scott, you're reducing the risk, as I said before, because you've got a development of 100 units, okay, and you're going to have a small percentage of bad debts. I think our non-payers and our voids run at about 1.5 or 2%, which is very low, very, very low. So we're running, as you know, we actually have just sold it, but we owned an estate agency, which we started from scratch called Life Residential, where we manage the properties. We sold it last week, actually, but we were running 5,000 properties in London. And I think our voids were like 45. You know, it was unbelievable. So, you know, everything is kind of brewing to make a really good cup of coffee in the residential market in London. Okay, so what you're finding is there's a lot of capital coming in for what they call build to rent, BTR, so kind of professional landlords. What that's done is it's increased the quality of the properties to some degree, but it's also increased the prices, because what happens is now you've got commercial competition. So I'm building a building, I need to put in a bloody nice gym, I need to make a community that people want to live. So it's all about customer retention. And suddenly, instead of us being a landlord, we're actually we're a business with customers. So we don't have tenants, we have customers. And we treat our customers like hotel guests. Of course, that's got slight increase in costs, but the relative cost increase is far less than the relative rent increase we can get, because people feel part of a community, they feel valued, etc. And and that's kind of the direction that we have gone and that we are going in. Okay, so we're trying to, and then the risk profile of the development, of course, is what you do. Do you buy a piece of land and take the risk of getting planning? And you must understand, when you do that, if you don't get the planning, you've kind of lost your money. You've got a mini field. Okay. If you can get that margin, that's how you make your most margin. So, you know, it's a risk return. The development risk we don't really see as a risk, because we tend to close our contracts in terms of the construction, etc. So just to give an example, through COVID, okay, we built, as I said, we built the tallest tower in West London, 57 stories, 700 units, and that was constructed through COVID. And believe it or not, our entire cladding came from Wuhan. Okay, so you can imagine our kind of blood pressure when COVID started, but we closed the contract with the contractor, so we had zero cost increases. In fact, we agreed to pay, I think, on a £200 million contract, we agreed to pay $1.5 million, and that was shipping costs, because shipping containers went up hugely during COVID, and so we agreed to pay some of the costs. And it was just a gesture of goodwill because of the amount of business we do with the contractor. And the Chinese cladding company also took some of the hit. So we kind of reduced that risk. And so the development risk we're quite comfortable with. We're super comfortable with the rental risk, because the supply and demand, it's going to take, I don't think it's soluble, actually, or solvable, actually, is the word. It will take 20 years at London at full capacity to build, to catch up, to actually provide the stock. The planning system in England is so bureaucratic and so difficult to navigate. And just give you an example, when I say about costs and difficulty of planning and restriction of demand, as you know, very sadly, there was the fire in London at Grenfell Tower. Now, the fire at Grenfell happened. It was a perfect storm. The building had bad cladding put on. It had no fire sprinkler system, etc., etc. So if you compare that building to one of our buildings, completely different. It's chalk and cheese, right? So we have full fire. In fact, we have the highest possible fire rating in our buildings. But what, in their wisdom, they decided to do was to say to anybody building a tower, and it went from 18 meters, from 30 meters and above down to 18 meters. Now, think about 18 meters. That's not that tall a building. That's like kind of, I don't know, 7 stories, 6, 7 stories. And they said, right, you have to have a second means of escape, a second staircase. Now, the rules in a tall building from a fire perspective is stay where you are, because you've got a fire system that works and that functions individually in every single room in our building. So obviously they kind of cracked a nut with a sledgehammer, and decided to put 2 staircases. Now think about what that happens in a building. You've just taken out 10% of your usable space, which increases the costs. So you have a situation where a lot of developments aren't viable, and a lot of architects have had to go back to the drawing board and redraw up. So that's just another addition to the restriction on supply. So when you look at it like that and you say, okay, we've taken out we understand the development risk, we understand the rental risk, we understand about taking the frictional costs, you can start working to getting a fairly decent return. Now, the cash and cash return starts becoming damn close to what the banks are paying now. Okay, of course, it's not liquid, but it's a cash and cash return. And I keep saying, I have friends that come to me and say, you know, we've done okay in the property business. Can we buy a flat for our kids, etc.? And I always say to them, I say, you have to understand, I'll sell you the flat, I'll give you the biggest discount I can, but you have to promise me, okay, you're going to keep it for at least 10 to 15 years. And I say to them always, and just to be sure that there's no misunderstanding, I'll give you a guaranteed buyback in 15 years at the cost you're paying today. So you cannot lose money. Okay, the absolute number. Of course, you're going to lose the income, but you cannot lose money, because that's how confident we are in terms of the prices going up. And you just have to look, you know, when I come back to South Africa, I just think of a place like Shelley Beach, where my parents had a timeshare in 1980. Say 3, there was nothing there. There was a row of townhouses on the beach. Now there's a whole city. Okay, and that's like over a period. And the same is happening in London. Now, you might be able to show a couple of the slides of what I'm talking about, Scott, about the regeneration.
So just before we go to regeneration, Gary, I want to go there. But just before we go there, there's a question from Stephen, and I think it sort of sums up with this slide I wanted to show. So when you're an international investor, the first thing you get offered often is Birmingham and Manchester and Liverpool, and there's lots of students and they need lots of student accommodation, and developers kind of sell to them. And I mean, I've heard this story. You and I have been doing this nearly 20 years together, and I've heard this story so many times, and I'm virtually almost yet to find people that make money doing this. I'll never forget in Manchester where 100 South Africans bought, you know, student accommodation, but it was 20 miles. I mean, that's like 36 kilometers from university. And when I was at university, trust me, I didn't want to live 36 kilometers from campus. Like, and needless to say, they couldn't rent it out. Like, you know what I mean? So these things all sound a hell of a good on paper, and then you have real life happening. And I just want to kind of reiterate, I've got a question and I've got a comment and a question for you quickly before we go to the regeneration. This for me is the difference between what I'm going to call that mom and pop investing, which is where I can't afford London. So I tell you what, I'm going to go to Liverpool or Manchester, and I'm going to buy an old house, and I'm supposedly going to renovate it long distance, by the way, which is now an impossible. Then I'm going to manage it. Then I've got one tenant with one, you know, management agent, hopefully going to get it. And there's all these risks. Or I could invest with a partner that literally is building the development, is owning the development alongside me, is managing the development and cutting out all the middlemen. And that just, I want to try and explain to people, that's the difference between what I call mom and pop investing and institutional investing, which is what Gary's trying to explain. I don't know, Gary, if you've got any comments on that before we move to the regeneration.
Well, just reading Steve's question. So, Steve, you're quite correct. There's been a huge flood of capital into the student market here, and it kind of defies belief, really, the amount of quantity that's happening. But what you find is that people jump on a bandwagon, and eventually there'll be oversupply. But people doing that are competing with funds. You've got massive American funds. You've got massive university endowments that are buying these properties, and it's difficult to compete with them. So, yes, you're getting a return. The capital returns on a student development? Here's a very subtle point you have to understand, okay? The returns on a student development are purely based on income, okay? So let's just say, for example, you've got income at 5%. You've invested £1 million, right? You've got income at 5%, so you've got 50 grand coming off your investment. That money is valued purely at a multiple of an investment. So if the market and the cap rates on student accommodation is, say, 4%, you'll get a multiple of 25 on your income. Okay, and if interest rates go up, that will reduce okay, you might be expected to get 6%, and then you've got a multiple of 15.5, whatever the case is. Okay, so on residential property, you have the income. The value you can also sell because of the build to rent market. You can also sell on the cap rates. And by the way, if you look at any of the cap rates in the UK, residential property is the best cap rate and the most stable cap rate right through COVID, right through running between at one stage 3.25 to now it's sitting at 4, whereas like the equivalent commercial is sitting at a cap rate of 6%. Okay, so the multiples are much more. But if you split up that building, you can also get the capital growth. Now you're talking about price per square foot. Okay, so income is generally based not on price per square foot. It's based on the market, etc. Price per square foot often has no correlation. In a buyer's market, has no correlation. I mean, I've been in an exhibition in Hong Kong when 20 years ago, where we'd go in and we started on a Friday selling properties at £650 a square foot, and by Sunday we're selling at £800 a square foot. Okay, which is like ridiculous. So that is the one fundamental understanding of what we do in terms of rental. Okay, so your exit and your IRRs and exit can be much, much higher than say what a student ultimately can be. Okay, a student accommodation, very stable, great business, and there's been a huge surge. If you just look at the planning applications, people are planning a student and co-living, but it's really simple. Why? Because they're smaller units, and you're going to get higher income on a smaller unit. You know, you're going to get relatively more on a 1-bed flat as opposed to a 2-bed flat from a cost perspective. Okay, but how do you sell that? You can only sell it based on the income. So you're not getting involved in property, you're getting involved in capital markets. Okay, and the people that should really get involved in capital markets are banks, funds that deal in money. And for the individual investor, you're not really dealing in money. You know, you're not saying, oh, I've got £50 here and tomorrow I'm going to invest it here and then I'm going to put it there, etc. You have to look at a long-term strategy. Our strategy actually is so simple and so old-fashioned, but it works. In fact, I had a guy I know, a big agent in London, said, you know, Gary, I've known you for years. He says, you're one of the only guys that I know is still doing the same thing you were doing 25, 30 years ago. But, you know, it's kind of old-fashioned, landlord and tenant, but do it in a much better way. I recommend a really good book, and the philosophy that we look at from a tenant perspective is the guy that started Four Seasons Hotel, Isidore Sharp. And he has a great biography, and where he says, put the customer first and foremost, okay, and everything else will follow. Okay, so sorry, Scott, and one other thing that we do is we tend to fix our interest rates. Okay, so in the good times, we kind of fix them. In the bad times, we let them float. Risk reduction. That's all we do, risk reduction. We don't expect to make massive money, but we will. When the markets boom, we will make a lot of money. But we make very solid returns.
A couple of comments there. You've just taken people from a school level to an honors degree to a master's to a PhD talking about cap rates and everything. So, I'm sure for
Gray
some
hair
people went straight over their heads. But my point being is that it's that type of stuff where not only in the VIP, I'll go into a lot more detail if people want to understand it, plus wealth going global. Gary, I want to come back to the fundamentals. And one of the things that I've learned from you and been part of with you is focusing on regeneration areas. They talk in property, location, location, location. But equally, they say in property, try and buy property with a twist. So talk to us a little bit about just, and I can put up the slides for you quickly. I don't expect people to be able to read all the slides, etc. But the point being is that if you want to just talk to us a little bit about the fundamentals of regeneration, and then also why you're now in West London and what the opportunity is in West London.
Okay, so the reason I'm in regeneration is because I could never afford to buy stuff in established areas. Okay, I could never create value. Whereas in a regeneration area, you can kind of create value if you have the vision. And that's one of the things about my experience when I mentioned about Shelley Beach is when you leave somewhere and go back over a period, you can really see the growth. So if you go back to Sandton, for example, 30 years ago, there was nothing. And if you go there now, it's unbelievable, right? So
well, you got a good picture for
okay, so correct. So that's kind of on the left. On the left was kind of when I kind of came to England, and I kind of liked Canary Wharf because you could go and rent something in an established area, was a bit old, a bit damp, etc. And yet you could go to Canary Wharf and rent something that's fantastic. It goes back to how the customer feels. Okay, and then we admittedly we rode that. So, and East London, the history of East London was it was seriously bombed out during World War II. And people and so it created a great opportunity. The buildings were built to a large extent because in the first instance it failed. Why? Because the infrastructure wasn't there. They hadn't put the tube line in, etc., etc. It's ultimately done. It's unbelievable, the growth and the change. So we kind of looked at that, and we happened to be based in West London, and West London is going through a transition. And West London actually is a bit of a no-brainer because it's much closer to the center of London, okay, than East London. But we were given a gift in the fact that they decided to build, I don't know if you guys follow the UK news, but you would have heard a lot about HS2 and it being cancelled. So HS2 is the high-speed rail link, which they were doing between London, Birmingham and Manchester. And in fact, they've just cancelled. It's gone so much over cost that they just cancelled the Birmingham to Manchester route. So we've ended up in a situation where we have the largest station. On the left is what were shunting yards. And now you can see on the right, and I could give you an updated photograph. It's ridiculous, the amount of construction. And so there's become a whole town centre. So we are in this location, we are by far the best connected position in London. So we are in zone 2. So imagine zone 1, zone 2, zone 3 of the tubes. Canary Wharf is zone 3. We're in zone 2, so we're much closer.
There's a map. And just find your map. There's your map there, basically. Just to
yeah. So if you kind of point out where West London, White City, you go a little bit left, stop a little bit left there. Whoop, stop there. That White City, you may have heard of White City, a massive development, the largest shopping centre in London. And then you've got to the right Westminster, and then you've got Canary Wharf. But the point is, in West London, the infrastructure is there already because the Elizabeth line, which runs east to west, comes straight through there. And then you've got HS2 and the tube. So that's why they chose the location, because it's where all three transport facilities meet. And so the infrastructure is there already. So, and we kind of pioneers, if you're just looking at that picture that Scott has on the right-hand side, just to give you an idea, this picture is taken from the 57th floor of a building that we've built. And if you look at the end of the triangle, but to your left with your mouse, that's another one of our buildings being built. That's going to be ready in April. We have another one across the road. That's the investments I'm talking to Scott about getting involved in, which is up to a third floor to be ready in about 18 months, 19 months time. Imagine in that triangle is going to be the largest single station in the whole of Europe, not in London, in the whole of Europe. Okay, so anybody coming from Birmingham will be ending up there. So you've got regeneration. And in fact, Scott, yesterday, you might well all know Ballymore. Ballymore, in my opinion, are the best developer in London. They create the best infrastructure. Well, just to the right of that development that I'm saying there, just if you go up, that, by the way, that big green area is called the Scrubs. It's like the third biggest park in London. And if you go just slightly up from there, there's a bunch of brown buildings. There you go, left, right there. Ballymore has just announced they've done a deal with Sainsbury's. They're building 2,500 units there. Okay, so if you think about what's going to cost them to build, if you think about what our cost is because we're out the ground already, and you think about the change in the area, that growth could be huge. Okay, so here's this investment philosophy. Okay, so we're taking something which works today and giving you pretty good returns. That, by the way, what you're seeing is, if you look in the right corner, you can see the building before we built the area and what we built. That's a great sign of regeneration. And if you can have the vision to say, wait, so Scott will tell you, a lot of people, when I started building that building, they said, you're crazy. Now they think I'm a miracle maker. So this picture that Scott has got up is we are built now. The three orange buildings in front is Imperial College. Okay, they've got planning permission, they're about to start building. So that whole area is going to transform. All that area that you can see behind is part of the HS2 redevelopment. That's all, and the stations, all part of the HS2 redevelopment. So here's the investment. Okay, we know, and we work on current rates, current rents versus current interest rates to make a return. You might not get the 6, 7, 8% return on cash and cash. You're probably going to get net 4.5% return cash and cash. But think about the massive growth between now and 15 years with the regeneration, where all of a sudden you're sort of in central London, because central London is going to move towards the west because of the density levels. So, and at that point in time, unlike student accommodation, you could choose to break up the building and sell individual units, and think of what the cap growth is. So over the period, the cap growth is there. And we all have to look historically, how did our parents buy a house for £10,000 in 1960 FTSE, okay, and then end up with a house that's worth £2 million today? How did that happen in a relatively short space of time? So, you know, I think that it's quite a subtle understanding to say. So my view is, if you'd say property is a long-term investment, you buy efficiently through reduction of frictional costs. Okay, you end up and you hold it. You just have to hold it. And over time, you can grow it. It will grow naturally through supply and demand, increasing population. Okay, as they say, God has closed the factory of land. He's not building any more land. Okay, he's closed that factory. So supply is going to be reduced. You've got increasing costs, etc., etc. And then you've got the addition. Okay, you have the absolute addition of the regeneration factor. Just where my per square foot cost today is not going to show any relationship to the per square foot cost in the different place, a bit like a place like Sandton becoming from going from one price to another price over a certain number of years. And that's really the philosophy of the strategy. And as I say, we've always tried to do it ourselves and sweat our capital, but obviously you can't keep holding property without sweating capital unless you can get credit. So, and that's why we're looking to kind of consolidate and make a fund. This what you're looking at now, by the way, is our platform for rentals, etc. Okay.
I'm just sort of showing people because they call them trophy assets, you know, aspirational, whatever you want to call it. And it's like so many people, you know, Gary, even when you and I were doing this 15 years ago, it took a hell of a lot of money even to buy one apartment. And then you had to go set up an offshore structure, and you had to get a mortgage, and then you had to manage the property and the hassle and everything in between. And, you know, what I love with what you're saying, and in simple terms, is that in the past, you used to, you know, I would help work with you, but we would help someone buy an apartment, and then they were kind of on their own, like go and own this apartment. Yeah, there'll be a management agent, whatever, but it's kind of yours. Nowadays, you can partner with you in the development. You're owning a piece of the building, I'm owning a piece of the building, you know, Joe Soap's owning a piece of the building, and we're holding it for 5-10 years, and you've got a full management solution, cutting all the middlemen out, which obviously is increasing the return, reducing the risk. And, you know, when we exit, there's multiple exit strategies, whether it's selling them off individually or selling them to an institution or whatever. I mean, have I summed it up, you know, in simple terms for people?
Yeah. You know what? Can I give the bottom line? We're in the business not making money. We're in the business of not losing money. Okay, so we start off with the premise we don't want to lose our money. That's the first thing. So if we break even, we're happy. We know that we'll make money over the long term. It just depends how patient you're prepared to be. Okay, and that's the fundamentals, right? So one of the biggest frictional costs now, of course, is finance. Okay, if I can be a cash builder and developer, okay, we're probably paying 10% for our money just on the development side. So if you start stripping it back and you're cash and you've got a group of investors and you're building for cash, okay, the margins are enormous, okay, but over a longer period.
Yeah,
the IRRs become huge.
Well, look, I've squeezed more time out of you than I asked for. So you promised to give me 15-20 minutes, and Cheryl said, "How can I get in touch?" You know, Cheryl, between Gary and I, we're going to be putting an opportunity together. It's going to be on the Migrate platform. People will be able to invest directly alongside, with Gary and the team from a partnership perspective. So yeah, just watch the space. It's literally, funny enough, while Gary was on live, Ian Cohen, his partner, was phoning me going, hey, we need to do the numbers because we were having a meeting yesterday about the numbers. So it's a work in progress in terms of where we're going.
Scott, there's just one question I just saw from Caroline, just questioning on overvalues and what is the value of a property. So Caroline, my belief is the value of the property is the income it produces. Okay, that's very simple. If it doesn't produce an income, what's it worth? It's worth whatever anybody will pay for it because they fancy that property. Okay, with residential property and the liquidity of residential property, it's worth what the income is in today. But you know what? At some point in time, there'll be someone that wants to buy that property from you for an inflated price.
You know what I love, Gary? You weren't on an hour and a half ago, and I literally started an hour and a half ago, and I showed them all the international markets, and I said, whether you own a house to live in or you own a house to rent, it should be based on the income of what you can get for it. So the nice thing is,
Scott, interestingly enough, the people that buy the house to own to live in, it doesn't matter. It's your home. As long as you're happy there and you can afford it, doesn't matter. And that's why people pay. So if I've got a really nice home, someone will buy that from me at an inflated price because there's a real value to that. At this moment in time, majority of the market is just income based.
Yeah, no, brilliant. Listen, I'm going to bounce. Thank you very much for your time. I really, really appreciate it.
Absolute pleasure.
There's a hell of a lot of questions.
I hope your weather is all better than mine. It's crap, London.
There's a hell of a lot of questions that come up. Shane will be taking them all, and I'll be answering them in the VIP room. But this, I'm sure, will not be the last time Gary and I chat. I always joke with people. Him and his partners pioneered furniture packs and rental guarantees, and everything 25 years later, so that international investors could get into the London market. And what I'm really excited about is with him pioneering this buy-to-let space or buy-to-own space using technology now, and it's going to be a game changer for everyone. So thank you, Gary. I'm really excited about it.
And if anybody ever comes to London, feel free to contact me and we'll take you around, show you with pleasure.
Awesome. Keep on, mate.
Cheers, guys. Thanks very much. Bye. Bye.
So did you enjoy that? Amazing man, huh? And you can learn so much from it. So let me know in the chat box what you thought. And just while you do, because I can see that Connie asked a question. So we were actually there in February this year. And this is the tower now. It's all built. The tallest residential tower in London. And at the top here, that's the top of the penthouse, biggest penthouse in Europe. And I did tell the story yesterday in the VIP, but it was really interesting because I used to work for this construction company, and they actually built this construction company is the company that built that tower. And 20-something years later, I was at the top of that tower. There I am with 20 other investors, and we were actually negotiating to invest in this building. We are still negotiating with Gary. We're trying to finalize how to get the mortgage arrangements done. But in simple terms, this is my intention here is to own a piece of this building alongside Gary. And I hope you can all understand why now, because now you start to get the sense of what I talk about here and ultimately truly becoming an investor. So you can run around and buy houses and apartments and go do student accommodation and all that sort of stuff, or you can partner with someone like Gary. And hopefully you're starting to see now the difference between a mom and pop investor and an institutional investor, and the way they think, the way they manage risk, the way they protect their capital, the way they cut out all the costs that, again, mom and pop investors pay, and how they actually increase their returns in terms of that process. So Jacqueline said, yeah, that was like a whirlwind tour into another world. Really exciting. Looking forward to be part of it. Yep, completely. It's just, again, there's a whole nother game that's going on that most people are not basically invited to. And what I'm trying to do is teach you and share with you what is available. Now, if we pivot to a whole nother opportunity, and I don't have time to go into this now, but Ann Wilson is an incredible lady. She's a good friend of mine, and she's the best that I know in terms of teaching about the stock market. So this is about investing in the stock market, and it's specifically going through ETFs, which is the most affordable way to be able to do it. So as part of the resources later, you're going to literally see a video that Ann and I did for this challenge in terms of how to invest in the stock market. Now, I'm conscious of time, so I want to kind of bring this all together for you today. Oh, and by the way, I did say I'd answer cap rates. I will go through that in the VIP session. So in the VIP session, I'll explain to you the difference between yield, cash on cash, cap rates, internal rate of return, and some of the important investment analogy that you need to know. Okay, so reminding you that if you're feeling overwhelmed, don't worry about it. Remember that I've shown you this slide multiple times. Where's my little mousey gone? There it is. I've shown you this little slide, and maybe now you're not feeling so unconsciously incompetent. Now you know what you don't know, which is not a bad thing in terms of that process. Okay, so what I want to share with you is tomorrow I will take you through the Wealth Hackers. So it's the T-shirt that I wear with pride, and it's what we basically call our Netflix for wealth. And I will literally take you through it, because tomorrow I'm going to share with you how you can get access to Wealth Going Global, which is all about the right information. Now, you can appreciate today we've tried to go through how do you find the top 5 countries, how do you find the top 5 currencies, and how do you find the top 15 assets. And like I've shown you, there's a lot more substance if you go into Wealth Going Global. So if we go down here and you go to Wealth Going Global, and wrong one. And go here, and you go to Wealth Going Global, which is part of our Wealth Hackers. You can literally go down, and each one of the modules, countries, and you can see all the information is down below with all the attachments. You've got the currencies, which is all the stuff from James Painter. And then even down to the assets, you've got all of the stuff about the assets, and then you've got how to build your global portfolio. So everything that we've discussed is actually here. And just by the way, all the calculators are here. So all the different indexes that I showed you today, the GIDS calculator and everything, it's all here. We actually share everything with you so that you've got access to everything. And so that is, and then the next thing is asset class mastery. And I basically took you through and showed you already today that if you go to asset class mastery, that is all the different assets. So again, it's impossible for me in 2 hours to take you through all of them. I've wanted to explain them and explain at a high level what they're all about. But if you go through this, each and every one of the assets, there's actually a lesson here teaching you about that asset. So I'll take you through the Wealth Hackers tomorrow and how you can actually join the Wealth Hackers in terms of that process. I wanted to finish off, though, with a way for you to be able to get started and to be able to earn passive income. So how do you build globally diversified passive income simply and safely without making the mistakes that most people make when trying to do it by themselves? Now, you've all got access to the sheet, and you should have all downloaded the sheet. And again, you can fill in the different parts in terms of this process. Now, this was the little diagram that my partner Shane drew for us, because he said you've got Jill and Joe Soap and they're in their bed and they want an asset. So they want a house, they want an apartment, they want an alternative asset, whatever it is. And they basically want to get paid while they sleep. Okay, so while you're sleeping, you want to get paid. That's the ultimate dream. The problem is you come along to a course, a challenge, or something like that, and you do all this stuff, and you kind of read books and courses and find mentors and everything else. You do all this stuff and you fall off. So what Shane said is, how can we get from A to B as quickly as possible? How can we help someone get from A to B as quickly as possible to be able to get a passive income? And that became our objective back from October last year. And I always say to people, it's all about getting paid. And the reason there's a little camera here is this is that moment to take out your phone and literally take a picture in terms of that process. Now, we as a team have made it for you. So you can literally go here. I showed you yesterday for free. You can go along and you can go to the Wealth University. You can go to the classroom, and you've got a course here by me, which is the psychology and everything you need to know to kind of get started. There's 7 different lessons here. And then you've got a course from my partner, Alex, which is the Investor Roadmap. And it's 5 short lessons on literally setting up on the platform. So if you want to do it all yourself, you literally have access to be able to do it. But what's interesting to us is that statistically, we've done this challenge a number of times, and we've looked at the results, and about 352 people, when it's free, signed up. About 80 turned up, about 10 funded their wallets, and about 8 invested in the deal. And if you look at it, it's a whopping 2.23%. So when something is free, 2.23% of people finished it. Now, we've given you access. You can go and do it. We've shown you where to do it. You can literally do it for free. But there's a saying that I love, and I've learned this over and over again many, many times. When you pay attention. You know, Russell Brunson, the gentleman here on the right here, he made $3 million in 90 minutes. And the reason being is that when you make a commitment to yourself and when you actually invest money, then you really take something seriously. When it's free, most people don't. And even this challenge, it's amazing for me, the drop off between day 1 and day 5, because it's free. And that's why it's always so different for the people in the VIP, because they pay, and because they pay, they turn up. So our 30-day passive income challenge is something that we've evolved to take what you can already access for free and to take you through these 4 steps. Sign up, complete your profile, fund your wallet, and invest. We fundamentally believe that each one of these steps, sign up, complete your profile, fund your wallet, and invest, will ultimately equal your payday. And people say, yeah, but I don't have time. We go, well, it takes less than 1 hour a week. So for 4 weeks, it takes 4 weeks. It's less than 1 hour a week. And ultimately, it sets you up for success. And if you remember yesterday, we were having some fun with Monopoly. Well, maybe this is your chance card. This is maybe your card to keep you, to get out of jail free. Just like when we played Monopoly. And whatever your jail is, maybe your jail is your job. Maybe it's your country. Maybe it's your company. But ultimately, getting paid while you sleep and having a payday every single day ultimately is your get out of jail free card. And so I want to recap quickly just some of the passive income traps that hold people back. The first is relying on a single source of income. Again, most people have one single source of income. They're an employee, or they might own their own business, they're self-employed, or they own one property, but they've got one single source of income. Whereas the wealthy build multiple income streams that work together. I've shown you how that works. Number 2, investing without a strategy. Most people invest blindly, hoping for returns. Smart investors follow a proven system. Number 3, thinking you need a lot of money to start. Truth, you can start earning passive income with as little as $10. And number 4, buying houses will fund your retirement. Truth, your home doesn't generate passive income, it costs you money. And traditional rental properties, they're far from passive. So, do you remember yesterday that we started off and I said the 7 pillars to freedom? You need to get paid while you sleep. You need to own assets which are hassle-free, simple, and safe. You need access to the knowledge the top 1% have. You need access to the partners that the top 1% have to navigate the uncertainties. You need to have time freedom. You need to diversify across countries, currencies, assets, partners, and time. You need to protect your wealth, have a plan B, and have peace of mind. It all comes down to having a passive income, and it all comes down to being paid. Now, you can go and do it for free. We've already given you the links. But the question most people ask is, so how do I actually get paid? And Bram, you said, what are the stats when people, what's the stats when people paid? So I'm going to take you through this because we basically created the Payday Accelerator and we looked at it and we said, what do we need to do to support people to be able to get them the results? So for me, you've got the 30-day passive income challenge. And this is where it's a 4-step process where you literally go through. We sign you up, you complete your profile, you fund your wallet, and you invest. Step 2 is that you literally have a wealth discovery call. So you sit down with one of our team and they understand what you're wanting to achieve. They understand where you're at. They understand what has prevented you from achieving your goals to date. They want to help you find the fastest way to help you achieve it. Step 3 is that you get access to a community of like-minded people so that you can work together and participate, whether it's on the school platform or on the WhatsApp group. You'll be amazed. I'm part of a push-up challenge at the moment. I did 203 push-ups this morning. And it's incredible because when you're part of a group and every single day people are motivating you, it just inspires you to be able to go further, go faster, and go together. And then step 4, which is probably the most important part, is you've got coaching and accountability. You've got 4 weeks coaching and accountability sessions with an internationally qualified wealth coach. So myself and my partner are internationally qualified wealth coaches, and we use what we've learned over the last many years of being coaches in actually to help people use coaching methodology to get results. According to Harvard, you're going to be 400% better off if you have a coach than if you try and do it on your own. And a good coach can change a game, but a great coach can change a life. And, you know, when you look at it, it's amazing the different testimonials that we get from people. You guys are so honest, sure, blessed to have access to all this information, boggles my mind, but with partners like you, I'll also get there. Like eating an elephant, how do you do it? Bit by bit. Your network is your net worth. The coaching and hand-holding we're receiving is actually priceless. The presentation is very inclusive. It's for ordinary people getting involved. It's a fair price. It's very clear. People get to participate during the presentation. May I please agree with Alex? Mind-blowing. I'll climb Kilimanjaro with him. He's the coach. He takes people through this process. I did the 30-day challenge. I started investing. It was worth it. Passive income changed my life and put me on a wealthy mindset now. Absolutely. The 30-day challenge was worth the time spent on it. Thank you. I'll be revisiting again tonight. Wealth Migrate has changed my entire outlook when considering investments. Where have you been all along? I guess in my case, rather late than never. And Derek, if I can do it, anyone can do it. So how have we put this and how have we actually set people up for success? And why do we call it the Payday Accelerator? Well, step one is the passive income challenge and access to the recordings. What do you get? You get passive income. The value, $399. A discovery coach, call with a wealth coach. That gets you clear on your next steps, $99. Access to the Global Wealth University and community knowledge. That gives you $99 worth of value. Coaching and accountability, that's about results, $400 worth of value. Peace of mind, that gives you freedom, which is actually priceless. And then smart investing, using technology to do this safely and simply, that gives you a system, priceless. So you put it all together, it's $997 worth of value. But we're also going to chuck in some extra bonuses, which are important. The first one is the Freedom Calculator. So it actually helps you calculate where you are and where you want to get to so that you can ultimately come up with how are you going to get to your freedom number. Then you got your wealth plan, which is basically how do you get clear on your why, your how, and your what. Imagine having your own wealth plan. Then bonus number 3 is a roadmap, going from $100 for the next 20 years to $3.3 million in equity, or roughly $15,000 in passive income. You can literally map this out in terms of that process to be able to get to where you want to get to. And then finally, bonus 4, a return on investment calculator. I mean, if you're ever looking at what you need and you want to calculate the return on investment, if you're going to invest $100 a month and you're going to invest $97 in some sort of program, what is the return going to be? Well, over 1 year, it's 40%, or roughly $38. Over 2 years, over 5 years, it's 1,125%, or $1,000. Over 10 years, it's 4,950%, or $4,800. And over 30 years, it's 76,000%, or $74,000. I mean, at the end of the day, would you invest $97 if over the next 30 years, it was going to give you back $74,000 in your pocket? So you take that, and again, the steps are, you've got the passive income challenge, you've got the discovery call with a wealth coach, you've got access to the Global Wealth University, you've got the coaching and accountability, you've got the peace of mind, and you've got the smart investing. You chuck in the bonuses, and basically you've got the first bonus, which is the Freedom Calculator, you've got the wealth plan, you've got the wealth roadmap, and you've got the return on investment. And that gives you clarity, it gives you direction, gives you hope, and it gives you confidence. You put it all together, it's worth over $2,200. Now, we had choices because we could keep this exclusive or we could try and help everyone. If we make it exclusive, then it's one-to-one bespoke coaching, which is what we do at the mastermind level. Or how do we democratize and make it available? So we decided not to charge $2,291, and we decided to make it more accessible. Now, I'm not going to charge you $1,000. It's well worth more than $1,000. I'm not going to charge you $1,000, but what I'd like to do is, would you pay $1,000 if all it would help you do was achieve your freedom goal? Would it be worth it to you? Yes or no? Just type in the chat box for me. Just think about it. If you would invest $1,000 and it were able to help you achieve your freedom goal, would it be worth it to you? Yes or no? So I can see Sylvia said yes. Kevin said yes. This is really important. Zandile said yes, Justin said yes, Gary said yes, Kerry said yes, Tammy said yes. What about if all it did for you was provide you with 4 simple steps to get passive income of a 1K or more? Would it be worth 1K? Yes or no? What about if all it did was provide you a system to get you passive income safely and simply? I mean, a lot of people talk about passive income, they talk about it proverbially. But what about if you were able to get it safely and simply? Would it be worth $1,000 to you? And if all it did was provide you with confidence and clarity to get results that you've dreamed of, would it be worth $1,000? These become really, really important questions. And lastly, if all it did was provide you with a way to get paid while you sleep, would it be worth $1,000? I mean, again, Warren Buffett says, if you don't figure out a way to get paid while you sleep, you're going to work until you die. And so this is a way, a methodology. I mean, we've given you the training for free, but this is actually a coaching and accountability group that come on a 30-day challenge to be able to get the results. Now, a program like this would normally be $997. We're not charging $997. In fact, most programs out there would be in the region of $297. We're not even charging $297. And the reason being is that our purpose is to help you invest like the top 1%. Everything that I've shared with you today and yesterday is empowering you to invest like the top 1%. So you take everything that you're going to get you, the passive income, the next steps, the knowledge, the results, the freedom, the system, the clarity, the direction, the hope, and the confidence. It's worth over $2,291. And for us, our payday accelerator is literally $97. We've made it as affordable as possible. We also believe that the sweet spot of $97 is the right amount where it's not too much to stop someone doing it, but it's enough to create enough pain that someone actually does it and commits and is then coming on a journey and is going to be held accountable to be able to get results. So again, you can do it all on your own, like I did for 14 years, or you can join a like-minded group of people that are going on a journey, a 30-day challenge. Alex, my business partner, will be there as your wealth coach to hold you accountable, to coach you. It's less than 1 hour per week, and it'll literally take you through the process. I can see that Shane has put up the link there, or you can just literally go to this link, diversifiedpassiveincome.com/payday. And if I click on this link and just show you here, you can literally go through it and you can see everything that you get. So there's a video from me. You can see all the different value adds that you get. You've got the bonuses and everything else. And you can literally go and read what are the results you'll get. You can go look at the real, the feedback from other people. So it's all here in terms of the process. All you do is you fill in your details and then you fill in your payment details and you literally can get started today. So again, you can go online and do it for free if you want to, or if you want someone to hold your hand, to hold you accountable. And statistically, when you do it in a group of like-minded people, you have a 70% chance of succeeding. So again, reminding you, when people do it on their own, according to our own data, 2.32% of people finish. So on your own, 2.32% of people finish. When you do it in a like-minded group with coaching and accountability, the stats show over 70%. And that's why we actually work with a results guarantee. So if you follow the process and if you do the steps each and every week for the 4 weeks and you don't get results, then we give you a money back guarantee. That's how sure we are of helping you get your results. And for those that actually complete it, so I give you the bonuses once you complete it. Again, I am incentivizing you. It's ethical bribery, call it whatever you like. But for those that actually complete it, I will then take you on a course. It's a home study course, which will help you move from the employee or the self-employed or even the business owner quadrant to the freedom of the investor quadrant as quickly, safely, and predictably as possible, without being trapped by the financial industry or giving away your power to someone else, and without adding any additional stress or hassle to your life. So if that sounds good to you, then I would recommend that you join the Payday Accelerator. I mean, it's literally $997. That That home study course alone is worth $997. And you literally get that all included in the Payday Accelerator for free as a bonus. Sure, people are signing up there. Anyway, so just to remind you, what do you get? You get the passive income challenge, which gives you passive income. You get the discovery call, which gives you the next steps. You get access to the university, which gives you knowledge. You get coaching and accountability, which gives you results. You get peace of mind, which gives you freedom. You get smart investing, which gives you a system. That's worth $997. Then you get the bonus of the freedom calculator, which gives you clarity, the wealth plan, which gives you direction, the wealth roadmap, which gives you hope, and the return on investment, which gives you confidence. You put that all together, it's worth over $2,000. You add together the final bonus, the fast action bonus, which is only going to be available for people that partake this week, and you'll get the 4 steps to Wealth Formula home study course, which is ultimately gives you the insight. And can you believe it? It's $3,000 worth of value. But because this challenge is something that we believe so much in, we literally have made it a no-brainer for people. Literally a no-brainer. $97. You get all of that for $97. And you know, why do we make it so affordable? There's 2 reasons. Firstly, we've built every business based on Zig Ziglar's principle. You can have anything you want in life if you help enough other people get what they want. If we can help lots of people get passive income, then we can also build more passive income for ourselves. So that's the first very, very important principle. And the second is that our purpose is to help everybody invest like the top 1%. If you haven't figured that out already over the last couple of days, we are intent on helping everyone invest like the top 1%. And one of the things Shane said to me over and over again is, Scott, stop being a teacher. Stop teaching people all the theory. They need to be able to get practical. They need to be able to get started. They need to be able to get results. And it was his idea. It was an incredible idea. How can we help people get results in 30 days? And like I said to you, we did it for free. 2.32% of people actually finished. So we said, fine, we're going to do a paid for service with coaching and accountability to make sure we put all the different pieces of the puzzle in that people need to be able to get results. And that's why we call it our Payday Accelerator, because at the end of the day, we want everyone to have a payday in terms of that process. So take advantage, go along to that link if it's of interest to you. If you want someone to hold your hand and literally take you through that process, then Alex is your man. So it's time for the action steps to wrap up for today. So the action steps for silver are, and I'll remind you that this is compulsory and that gold is a bonus. So for silver, it's fill in your top 5 countries, fill in your top 5 currencies, fill in your top 15 assets, join the passive income challenge. So the link there is the diversifiedpassiveincome.com/payday. And then finally, share one key takeaway in the Wealth University community. And again, I just want to recognize the people that shared from yesterday. There's so much value when you go in here, and some people have shared and just sort of put it in here. So Jacqueline went and put in her key takeaways. Well done to Jacqueline. And others went and they did it where the recording was, and they basically went and put it down here. So Reg, Nisha, Corey, Ilza, etc. There's so much value when you actually go in and put in your takeaways in terms of that process. For your gold, you don't have to do it tonight, but I would recommend it. Watch Ann Wilson in terms of ETFs, and then complete your risk tolerance questionnaire in terms of that process. If you want to book a discovery call, as always, you can talk to one of our humans, and they can literally help you understand where you're at, where you want to be, and help you get from A to B in terms of that process. And now it's time to go to the Q&A. And what I'm going to be doing in the Q&A is I'm basically going to be running through today, what are internal rate of return, what are yields, what are cap rates, what was Gary talking about, because it's the language of investing which becomes so important from a sophistication perspective. I'm also going to be going through structured notes, just as an example of that as an asset class. And so if you want to join the VIP, you still can. Again, reminding you that there's over $8,000 worth of value, and you literally get it for $47. Plus, you get this workbook. And I'm super proud of this workbook because I think it makes life much, much easier for everyone. So you can literally go through, and you come down to day 2 here, and you can go through all the different core concepts, what all the different assets are, whether you're invested in them, the risk profiles, the top investments, how do you build your diversified risk, and your action items, etc. So it makes your life really, really easy all in one place. you can still literally sign up and join me in the VIP room. Scan the QR code if you're not part of the WhatsApp group. Join the university. I remind you that this is the formula. You need to diversify across countries, currencies, assets, partners, and time. It's all about passive income. You need to use the paid framework. You need the right partners. You need access to the deals. You need the right information, and you need diversification. And this is truly how you get paid a diversified passive income of $1,000 or more as soon as possible. So you've got the 30-day passive income challenge. Use it, don't use it, in terms of someone holding your hand to get your results. The plan for tomorrow is how to build a diversified portfolio. So tomorrow I'm going to introduce you to our family office, and I'm literally going to take you through asset allocation and how to build a portfolio. And again, this is based on what the wealthiest people in the world are doing so that you can literally copy them. I'll see you tomorrow bright and early. As Nelson Mandela always says, money won't create success. The freedom to make it will. To those in the VIP room, I will literally see you in give me 2 minutes or so. I'll come across to the VIP room. If you want to upgrade, come and join us there. If you're part of the VIP and you don't have the link, just go in the WhatsApp group and ask and/or email Shane at support@wealthuniversity.org. And thank you all for your time. I hope you enjoyed it. I really love sharing with Gary and everything that the man does. And hopefully it gives you great insight into the difference between a mom and pop investor and an institutional investor, or someone that's investing like the top 1%. I think it's so, so important for you to know. So as always, an honor and a privilege. I'll see you tomorrow. Tomorrow we get even more powerful. Okay, so tomorrow, again, with the family office, you're going to learn what the top wealthiest people in the world are doing. And if the top 579,000 people in the world are doing it, and if you take 50 years worth of trend analysis, you should probably be doing it as well. And the chances are you're not. So tomorrow becomes so important in getting yourself set up for success. And thank you to all the kind words coming through. Really appreciate it. I'll see you tomorrow in the VIP room. I'll see you in the VIP room. No. Give me 2 minutes. Cheers.